Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
Wednesday, April 21st, 2010. Whenever I get asked about my opinion of the market, I always have to put it in a disclaimer that I have an opinion on the market because I've been doing this a long time, but it has nothing to do with the way I manage money. An intellectual vacuum is filled with partial differential equations in the academic papers. Today's guest is Greg Morris. Gregory L. Morris is Senior Vice President and Chief Technical Analyst for Stadion Money Management. Stadion utilizes a technical rules-based model to oversee the management of over $3.7 billion in investments in two mutual funds, separate accounts, and 401k plans. From 1996 to 2002, Greg was CEO of Murphy Morris, Inc., the leading provider of web-based market analysis tools and commentary, with his partner, John Murphy. In 1992, he published a book on candlestick analysis called Candle Power, now available in paperback as Candlestick Charting Explained, and he has a second book, The Complete Guide to Market Breadth Indicators. Greg has appeared on the Financial News Network, Fox Business, CNBC, Bloomberg TV, and was featured in Business Week in 2008. Greg is a graduate of the University of Texas at Austin and has a degree in aerospace engineering. From 1971 to 1977, he was a Navy F-4 fighter pilot and was selected for and graduated from the Navy Fighter Weapons School known as Top Gun. Greg and his wife Laura live in the mountains of North Georgia. Greg Morris, welcome to the program.
Nice to be back, Ed.
Greg, there must be something in the water in Georgia. I've interviewed a number of analysts who've chosen to make their home there. Bob Prechter, Chris Carillon, Andrew Cardwell. What's going on there besides droughts and floods?
Well, I think up in the mountains of North Georgia, when it never gets over 90 degrees in the summer, that has a lot to do with it for me. But I don't know about the rest of them. Lived in Dallas for 35 years, and the heat just became unbearable. Kids and grandkids are still there, though.
That's quite a biography you've got, and I think a person could be forgiven for forgetting to ask you how you made the jump from Top Gun to technician.
Yeah, it looks like a guy that can't hold a job, doesn't he? When I was in the Navy, I was interested in the markets, and I bought a few stocks. I didn't have any money in late '72, and they went up, and I thought I was a genius, and I bought them because they had dividends and good earnings, et cetera, and all that stuff. And then the bear market that started in January of '73 lasted for 2 years. I gave almost all of it back. And when I sat there and I saw my account value plummeting and the fundamentals continually getting better on the stocks that I owned, I said, there's something wrong here. This just isn't right. And that's what caused me to go out and look. And probably the first book I read was The Art of Low Risk Investment by Michael Zahorchak. And it basically was a technical approach, but I don't think in his book he ever used the words technical analysis. But he took moving averages, he used the advanced decline line, the New York Composite Index, and a bunch of stocks. And I did that by hand for years before the Apple II came out. So that's kind of how that started.
I see. I'm sure most of our listeners caught the name John Murphy during the introduction. I'll bet there's a story you could tell about how you came to have a business partnership with John Murphy.
Sure. A good story. Well, I was a software developer in the 80s and early 90s, and John Bollinger at FNN really liked my software, or anyway, he said he did, but he had me on out there an awful lot. And one time in the mid-'80s, I met John Murphy in the green room at the FNN studios on Ocean Park Boulevard out there, probably 1984, 85. And we just struck up a friendship. Had him at a seminar that I was putting on with an investor group in Dallas in the early 90s. Paid him an honorarium to come down and speak, something that he or I, when we were out speaking, rarely got back then. And I had this idea that the internet was going to be a new medium, and I approached him as I was driving back to the airport. I approached him about starting a company to develop educational services for investors, and of course it'd be along the lines of technical analysis. And he was interested, so I put together a PowerPoint and actually flew up to New Jersey to his house, and we went through it, and we decided to put some money into it, and that's how Murphy Morse started. And it was a really good run. We had a good website, had thousands and thousands of subscribers. We put out CDs. We both had written books. Yeah, it was a lot of fun, but it was a lot of work also.
Oh, I'll bet. Say, explain to us what you meant in the opening quote. I have an opinion on the market, but it has nothing to do with the way I manage money.
Well, that really came about after John and I started a mutual fund. We had a money management company. We started in '99, and then in 2004 we converted it to a mutual fund using the same management style. And when you publish information under the auspices of NASD, which is now FINRA, they have to sign off on everything that goes out to the public, whether it's on the internet or it's a letter or whatever it is. And I was writing a weekly piece for the Murphy Morse Money Management website, and our distributor would always have to review it before I could post it. The distributor had a guy that was kind of our go-between with the NASD, which, like I said, is now FINRA. And he knew what they would expect, and and then everything eventually ended up with FINRA for their approval, but we could go ahead and post it. So basically, it's real simple. I have learned to not speak in absolutes. Absolutely. Absolutely not. Yes. As an example, if I said our money management style avoids bear markets, they would not approve that. But if I said our money management style tries to avoid bear markets, then that would be approved.
Well, Greg, I know your Stadian managed portfolio trust pretty much avoided the bear market in 2008, didn't it?
Yes. We had a 50% lead over the S&P on March 9th of last year.
Ooh.
We've given quite a bit of that back because defensive strategy that can protect you in bear markets is not going to be an outperformer in bull markets. But over the long term, we've got a huge gap between us and the market.
Oh, boy. We're going to continue with Greg Morse in a moment, but first a reminder that on upcoming programs, we'll have from Taniscott Capital, Jonathan Arder, and from Zurich, Switzerland at UBS, Michael Reisner. Greg, this is a point in our podcast where we like to talk about what's in the toolbox of the technician. You can take this anywhere you want, anything you think that's interesting to you that our listeners might find of interest. But one thing I definitely found of interest and would like you to talk about is the fact that, it seems to me most technicians spend most of their time following the S&P for their price information, but you use the Nasdaq. How did you come to that decision? Give us a little insight into that.
Okay. Well, originally, a long time ago, it was the NYSE. And because we used the NYSE, we used NYSE breadth data because we use a lot of breadth. But when Grasso wanted to take the NYSE public, he started letting in a lot of the listing requirements changed, and it opened it up to a lot of interest-sensitive stocks, preferreds, closed-end bond funds, etc. And it kind of changed the makeup of the NYSE. And the other thing is, if you're going to be a trend follower, you want to use a measure of the market that has a higher beta than other measures. And the Nasdaq Composite does that very well. In other words, it goes up faster usually than the others, and it goes down faster. And that's what you want to see because you're trying to pick up market movements. So we use Nasdaq Composite for our price measures, and we use Nasdaq Breadth for all of our breadth measures.
All right. Well, you wrote a book on breadth. Tell us about some of the tools you use, the breadth tools you use.
Okay. We use, in the model that I manage, we have 9 components. It's a basket of indicators. 4 of them are breadth-based. We've got an advanced decline measure, and that's not the advanced decline line. It's kind of like the McClellan Summation Index, which is the McClellan oscillator summed each day.
Okay.
We use a few different parameters, and basically, because we've rearranged it mathematically so that it is designed to pick up uptrends. And naturally, if you have something that will identify uptrends, it will show you downtrends and everything else. And also need to clarify, we don't see a trend at the bottom. I don't think anybody does, because I think that's just a guess. The market has to move up for a few weeks before our fastest trend measures can start turning on. We have a high-low measure. We have an up volume, down volume measure. And then we have one that I'd created a long time ago. I never liked to use breadth data on days like the Friday after Thanksgiving, where the market was open 3 hours or whatever, because, first of all, you didn't have much volume in the market. The prices rarely changed much, but when you're using breadth, you're going to get a full complement of breadth data on that day. In other words, you can't tell that day was any different than the other, because all the issues that traded are going to generate breadth numbers, even if they didn't go anywhere. And that's because breadth is equal weighted. If a stock is up a penny or up $10, it's still just one advance. So those are the four primary breadth measures that we use.
Okay, all right. Well, you also wrote a book on candlestick charts. What do you suppose are the biggest mistakes, or the biggest mistake that technicians make when using candlestick charts, and what suggestions might you have for the rest of us?
Well, Steve Nissen and I think Steve was there in '88 at the MTA out in Phoenix. I'm not sure if he was there or not, but that's when the Japanese had introduced to the MTA, anyhow, candlesticks. There was a big contingent from Tokyo there. I went away and developed software, and Steve went away and wrote books. And then after my software was out, a publisher approached me about writing a book, and I said, I don't have time to write a book. He said, well, it'd probably sell a lot of software. I said, send me a contract.
Yeah.
That's how the book got started. But over these years, I'd have to say I see this constantly. And that is that if you're going to have a reversal pattern, you have to have something for it to reverse.
Yeah.
And by that I mean if you've got a bullish reversal pattern, then you have to be in a downtrend. You cannot have a bullish reversal pattern in an uptrend. And with candlesticks being 1, 2, 3, 4, 5 days, trading days only, a lot of people will identify the pattern relationship in the price, and they won't consider the trend. Well, you can't have a morning star in an uptrend. I'm sorry, you're not going to have one. It's just like you can't have a head and shoulders pattern in a downtrend. You can have one, but it's not a reversal pattern. Does that make sense?
Yeah, absolute sense.
Yeah. So I see that all the time. And academia does this all the time also when they're doing pattern identification, even on classic chart patterns. They will look for patterns in isolation. And you're going to get totally erroneous data when you do that. You need to always find patterns that are trying to reverse something or continue something. In other words, you have to identify the trend of the market first and then identify the patterns in that trend.
Got it. Well, we're into our last 2 minutes here, Greg. Give us a little insight as to, and we won't hold you to this, but where do you think the markets are headed? What do you think's going on currently that we should be keeping our, one eye on?
You mean in the last 2 minutes, or?
Yeah, exactly.
No, we've had an exceptional up move since March 9th. One of the things that's been very interesting in this up move is that, well, first of all, you can't expect the volatility that we had in 2008 to just automatically dry up because the market has changed direction. The volatility was there for 9 or 10 months into this bull market. And Sam Stovall even put out a document that showed that we've had 5 pullbacks of greater than 5% in the first year of this bull market, which is more than any bull market since World War II. So there's been a lot of volatility. We've had an unbelievable rally here since mid-February with just hardly any corrections at all. the market can have a tendency to go to these overbought levels for a very long time, and that's one reason we never use overbought and oversold, because this is an uptrend. But it will correct itself. It always does. Whether that's the end of this cyclical bull market or not, I have no idea.
So you believe we are in a cyclical bull market as opposed to a secular bull market?
I do. I'm a big believer that secular markets are valuation-based, and we did not see valuations get down to the levels they need to be to start a new secular bull market. Mm-hmm. And, of course, as the cyclical bull ends and becomes a cyclical bear, it doesn't mean we'll see new lows in the indices. It just means the valuations will get down to maybe 8 or 9 or even 10 would be acceptable, somewhere down in that area.
Mm-hmm. Greg Morris, it's been great having you with us today. Is there anything else you'd like to mention before we go?
The trend is your friend.
The trend is your friend, except at the end?
Except at the end, yes.
Okay. Well, that wraps up today's podcast. From Seattle, I'm Ed Carlson, and from a recording studio deep in the bowels of the MTA's World Domination headquarters in New York City, it's Shane Squark. Send us your comments and suggestions, and let's keep our stops tight. Good day.